All right, let's break down what happened in the market on February 19th. Now, this was one of those days where if you only read the headlines, you got one story. But if you looked at where the money was actually moving, you got a completely different one. To really get to the bottom of it, we're going to lean on the morning report from PhilStockWorld and the end-of-day breakdown from the AGI roundtable. So, right from the get-go, the big idea was this. The market wasn't just dealing with one single headwind. No, it was actually getting squeezed, caught in what you might call a pincer movement, with two huge and pretty different forces pressing in from opposite sides. And this really captures that central conflict of the day perfectly. On one side, you had all this noise, these drums of war beating over in the Middle East, sparking real fear about a potential conflict with Iran. But on the other side, a much quieter but maybe even more powerful fear. The idea that the average American consumer was just completely out of money. It was literally war drums versus wary wallets. Okay, so let's jump right in and see how these two big pressures really showed up the moment trading began. The pre-market data, honestly, was like a flashing red light for anyone who was paying attention. And here you can see it in black and white. You've got the broad market futures, the S&P and the NASDAQ, both down pretty good. But look at the details. That's where the story is. You see crude oil spiking. That's the war fear right there. And at the exact same time, you see Walmart, the ultimate bellwether for the U.S. consumer, getting absolutely slammed. The pincer was fully engaged. So let's unpack that first pressure point. The threat of war. All the headlines were screaming about possible U.S. strikes on Iran. But according to the analysis we're looking at from PhilStockWorld and the AGI roundtable, there might be a whole other layer to this story. And wow, this quote from Phil Davis's morning report just cuts right to the chase, doesn't it? It basically throws out this idea that, hey, maybe this geopolitical tension isn't just about foreign policy, maybe it's also about profit. The suggestion here is that $1 billion in donations could be creating $1 billion a day in extra revenue. It's a really provocative thought, and it leads to a brand new concept. And that concept is what the AGI roundtable calls performative volatility. It's their term for what they think is happening here. The theory is that this whole crisis is, well, something of a performance, a piece of geopolitical theater, really, all designed to create this fear premium in oil prices, which, you guessed it, directly helps out the energy companies. Now, the AGI's logic engine ran the numbers on this, and the gap it found is, well, it's stunning. The market, you see, was pricing in about a 30% chance of a real shooting war. But the AGI's analysis, looking at all the logistics and intel data, put the actual probability at less than 10%. That suggests the fear that was jacking up oil prices was just massively overblown compared to what was really happening on the ground. All right, so that was one side of the pincer. Now for the other, the American consumer. And the biggest signal we got all day came from the biggest retailer on the planet, Walmart. This is a classic market head-scratcher. Walmart actually had a great fourth quarter. They beat their earnings. So why did the stock get crushed? Simple. The market is always looking forward, not backward. Nobody really cared about last quarter. They cared about what Walmart was saying about the next year. And that guidance, it was pretty grim. And that weak guidance from Walmart was seen as the big confirmation of another key AGI roundtable idea, what they call the affordability wall. It's this theory that after years of prices going up, the average person has finally hit a breaking point. They just can't afford to pay more for stuff, and a company like Walmart knows that better than anyone. And this right here is the big takeaway. For the last couple of years, companies could just pass through their rising costs directly to us, the customers. Well, according to this analysis, that whole era is over. Done. Walmart's warning shot basically signals that margin compression is coming, which means retailers are going to have to start eating those costs themselves, and that's going to hurt their profits. So you've got these two huge, gloomy stories weighing on the whole market. You'd probably expect everything to just be tanking, right? But underneath it all, something really fascinating was happening inside the tech sector. It wasn't just tech going up or down, it was a story of a massive rotation. And this slide just lays it out perfectly. Look at that split. On one side, you've got what the AGI folks are calling the SaaS apocalypse. Companies like Carvana, which is basically a tech middleman for used cars, were absolutely cratering. But on the other side, a company like Figma, which makes an essential tool for designers, was just soaring. So what in the world explains that kind of divergence? Well, this quote from the AGI analyst they call Sherlock, it just nails it.
The market is getting way smarter about what AI actually does. It's rewarding the companies that create indispensable tools that AI can make even better, like Figma. And it is punishing the companies that are basically just middlemen that AI can probably replace, like Carvana.
Okay, let's bring this all home and look at the closing bell. After a morning that was just jam-packed with fear about war and a consumer recession, you'd think the market would have ended the day in a pretty deep hole. But it didn't. The final numbers on the big indexes were actually hiding the day's real story. Well, you look at that, negative 0.3%. After all that drama, the S&P 500 barely moved. I mean, that's practically flat. It totally contradicts the panic we saw before the market even opened. So if money was flying out of places like Walmart and certain tech stocks, where did it go? Where did it end up? This tells the secret story of the day. While the financials and the tech sectors were down, look at who the winners were. Energy, no surprise, it benefited from that fear premium we talked about. And industrials, we're talking about companies that make real heavy stuff. This right here reveals the huge rotation that was happening just beneath the surface. And this big rotation is what Phil Stockworld and the AGI Roundtable are calling the physical wall. The idea is that money is flowing out of the matrix economy, software, code, financial middlemen, and it's flowing into companies that build and power tangible, real-world things: hardware, energy, defense, logistics. On this day, the physical wall stood very, very strong. So when you put all the pieces together, February 19th was really a masterclass in how the market thinks. The headlines, they were selling a simple story of fear. But the data, the real flow of money, it showed a much more complex, much more deliberate plan. A rotation of capital away from the consumer and software middlemen and into physical infrastructure and energy. And that leaves us with the ultimate question, right? When you look at the market, are you just reacting to the noise of the headlines, or are you actually listening for the signal in the data?